Hello traders, the title of the video is how to pinpoint false divergence trading signal. Do you want to pinpoint the false divergence trading signal? How one can recognize or pinpoint or identify a false divergence trading signal. We are recording this video today because a trader did ask me in a comment section at the 24 Elliot Waves YouTube channel where I was talking about the first and the third wave, and I was telling today that very often we see false divergences during the first and the third Elliot wave, and we see what we call a true divergence in the fifth Elliot wave. And the trader was asking me the question to explain what do I mean by false divergence. So we are recording the video today to help traders to pinpoint a false divergence trading signal. The first thing that we need to understand is that any divergence signal is just a warning. So you will first recognize that there is a divergence. You will acknowledge that warning that there is a bullish divergence or there is a bearish divergence. But with other things that I'm going to talk about in this tutorial, you will have a bit of idea whether that divergence is likely to be a bearish divergence, or you will have, correction, you will have a bit of idea at the end of this tutorial. You will able, to have a bit of idea or to pinpoint whether it's going to be a false divergence or a true divergence. All right. First thing first, a false divergence is a divergence that the price does not confirm. You need to understand that I said before that a divergence is a warning. When we see, for instance, a bearish divergence, the best technical indicator for the divergence trading is what? The stochastic indicator, not MACD, the stochastic indicator. So if you are talking about divergence, I recommend to traders that want to use to trade divergences to use the stochastic 833, nothing else. Well, you may use RSI, you may use MACD. I'm not saying that you cannot, you can, all right? But the best technical indicator is the stochastic indicator. All right. So you see the divergence. There is one here. Stochastic for a lower. No, this is not a good one. This is not a good one. All right, my friend. All right. Now, if you are here, if you accept that, now we are on a 50-minute time frame, so this is about market noise. But if you want me to use that as an illustration to you, all right. Okay, do you accept that? Okay, there's another one. Okay, we can say use this one also. All right. Now the price from a lower high, it's not a good one. Okay, it's not a very good one. So if you call this was a divergence, all right, anytime you see the divergence, the first thing that you need to do is to acknowledge the divergence. All right. But in order to pinpoint false divergences, you want to know, where those false divergences usually occur. All right. And I will explain it to you here. So one example is this. So if you are dealing with the ABCD chart pattern, if you don't know, you say, Joe, what is that ABCD chart pattern? It means that you need to go to www.stochastic-market.com and learn more about the ABCD chart pattern. So you are likely to see false divergence during the session that we call the A to B. You are also likely to see a false divergence from C to D. In this session, you are likely to see false divergence because the price is extending, all right, but you are seeing a false divergence. Another thing that I want to say to you is that you are likely to see, in order to pinpoint false divergences, All right, the first bearish divergence will take place in a rising channel. So the price is in a rising channel. Here we are, but the stochastic is pointing to us a divergence. Now we will not ignore that divergence, but the only thing that we will know quickly is that this divergence, this bearish divergence, is likely to be a false divergence because why? The price is in a rising channel. But you will not ignore the divergence straight away. You will acknowledge the divergence. So with the market pattern, using the market patterns, the rising channel, the declining channel, and horizontal channel, we can be able to pinpoint the false divergences. The false bearish divergences will occur in a rising channel when the price is forming higher lows, higher high, but the stochastic is exhibiting a lower high. If that divergence is just a warning, we will not ignore it, but the only time that we will sell is when the price breaks below that channel and retest it right there. That's the only time that we will attempt to sell. All right. I also talk about the ABCD chart pattern very often in this session here. We see false divergence, and also during this session here. Now, I need to remind traders that I'm very careful not to talk about a true divergence in this tutorial because I want to stay on this topic about false divergence. I will be recording another video when I will be talking about a true divergence, so don't worry, okay? Another time that we see a false divergence is, apart from the market pattern, the rising channel and declining channel, is when we are counting Elliot wave. So you see here we have a consolidation, and if you call this one a first wave, you are likely to see false divergences during the first wave. All right, but what I need to say to traders that are looking at divergence during the first wave, traders who understand the Elliot wave, is sometimes you may see that divergence in the first wave, but what usually takes place, that divergence, the reason why we need to take it as a false divergence is that very often, all right, that divergence will not produce, enough gain. That divergence during the first wave will not offer us the best risk-reward ratio. Though you may see that divergence or a bearish divergence after the first wave, and you start selling, understand that as you are selling during the first wave because of that bearish divergence, as the price starts coming down, there will be people trying to buy, and you can quickly be taken out of the trade. Therefore, false divergences, false bearish divergences, usually occur during the first bullish wave, and false, all right, bullish divergences occur during the first bearish Elliott wave. Though the price may pull back a bit, understand that there are other traders waiting to buy. This is what we talked about before, talking about the dump money, D-U-M-B, D-U-M-B, the dump money. So you are selling at the time when people are waiting to buy. You are providing the fuel for those who want to buy, and they will kick you out of your trade, and you are what they call the dump money. Therefore, those divergences are usually false divergences. So, false divergences, false bearish divergences likely to take place in a rising channel. False bearish divergence likely to take place in a bullish first wave. False bearish divergence likely to take place in the first part of the ABCD chart pattern and also in the second part of the ABCD chart pattern. All right. Another thing that I want to add here, so traders may understand what we are discussing here, is that if you have a pattern, all right. So suppose I draw a pattern like this, okay. All right. So suppose this is N pattern, all right. Call it N pattern, all right. So the pattern is completed, is starting here. and the pattern is ending here. Now, you know the pattern very well. You are likely to see a false divergence in the first part of the pattern, and you are also likely to see a false divergence during the last part of the pattern, but not at the end, because I will be talking about that when we come to the end, talking about true divergences. Because the false divergences are occurring, those are warning that are taking place prematurely. It's telling us to sell. It's telling you to sell or to buy. You see a bullish divergence. It's telling you to buy. You see, okay, a bearish divergence. It's telling you to sell. You see a bullish divergence. It's telling you to buy. You see a bearish divergence. It's telling you to sell. But because those are false divergences, they will occur when a pattern is not yet completed. The best time to sell is when the pattern is completed. So now, if I go back to the rising channel, it's a market pattern. The price is in a rising channel, telling us that the bullish momentum is intact. If you see any bearish divergence in a rising channel, those divergences are likely to be false divergences. But the divergence, we will not ignore the divergence. We will only tell the warning may come early. That's why sometimes they are false, because they come too early. They are telling us to sell, but it's not time to sell, or they are telling us to sell, but the price did not confirm it yet. So usually the true divergences will occur at the end of the pattern. Price may come out of a rising channel, price may come out of a bullish channel. We are likely to see true divergences at the end of a pattern, whether it's ABCD chart pattern, whether it's this pattern here. When the pattern is developing and the pattern is not yet completed, you are likely to see false divergences. Those are premature warning telling us to sell at a time when we shouldn't sell. Therefore, we will wait until, okay, the pattern is completed. I need to remind traders that a false divergence is a divergence that is not confirmed by the price. We will not ignore them. We will acknowledge them. But the only time that we will sell is when the price confirms those divergences, like a bearish divergence, price come out of a declining channel, retest it, or form a higher low, or price start forming lower low, lower high in another declining channel, or we have a reversal, or the market pattern is changing from bullish to bearish. All right. Now, talking about the first way where we usually see the first bullish way, when we usually see false bearish divergence, is because a trend is developing. The market is saturated by the bull. People want to buy more than to sell. Now, you see a divergence in the first bullish wave. Usually, those are false divergences. The price may pull back a bit, so you need to manage it carefully. That's why I say to you, do not ignore it. If there is an opportunity to sell, but be careful, know that it can be a false divergence because it's a warning, but we want a confirmation before we sell. If you look on this chart, as I show you here, we have a false divergence here. And again, you see this divergence here. It didn't produce much on a 50-minute time frame. If I place a vertical line there, this is what we are talking about during the first wave. All right. Hold on, please. So you are here, all right? You see now? So suppose this is the first way. I'm using my word carefully. Suppose this is the first way. This is the second way. Now you have your bearish divergence here. Now you want to see the first candlestick bar down before you want to sell. Price start turning first. So the price is already here. On that 15-minute time frame, you want to see the first candlestick bar down. So here it is bringing you all the way here. Now you want to sell after that. Look, it just went down a bit. And not much, and then going back up. Because this is what we are talking about the first way, first bullish way, people are preparing to buy. The opposite is also true, or similar situations occurring in a bearish first wave. You see, you will usually see false bearish divergences in the first, you usually see false bullish divergences in the bearish first wave. As you are trying to buy, the market is saturated by the bear. All right, you try to buy, and more people are willing to sell, and they will kick you out of your trade. All right, here again, you can see here, you see if you call this one first one and the second wave. So I'm saying if, carefully, if, all right, if You call this one first wave and the second wave. Here it is. If again, I'm choosing my word carefully here. I'm not saying this is the third wave, so don't use it as a trading signal, especially the fourth and the fifth wave. And if this is the third wave, you can see usually extended like this. All right, you usually see a false divergence during that time. All right, okay, it makes sense. All right, false divergences that will not produce anything at all. All right, all right. For divergences, especially during the third way you see divergences, because the fourth way is likely to be shallow. You don't want to give too much consideration to those ones. The true divergences usually occur when a specific pattern is completed. I'll talk about another pattern now, the Fibonacci pattern. So the Fibonacci pattern, the crab, the bat, the Gartley pattern, the butterfly pattern. So we have first, the first condition we have to have a trend, then a correction. You remember that? And then we have what we call ABCD pattern forming, okay, the bearish, okay, Fibonacci pattern. All right, so your Fibonacci pattern is completed here. So there was a trend first, that's the first condition. They probably went A, B, C, D. Now, either you are dealing with a crab pattern, butterfly pattern, bat pattern, or Gartley pattern, you have to understand the pattern. Again, if you understand the pattern, you will know that we are likely to see a false bearish divergence in this session, and also when this move is developing. The only time that we will expect a true divergence is usually when the pattern is completed. Another thing, it's like I'm talking about it already, but I will record another video when I will clarify the true divergence. But I think it's important that I touch upon that right now. Another thing that you need to understand, all right, when we are talking about false divergences and true divergences, all right, is that if there is, the price is, one thing you need to understand in the financial market, that the price is always going up from point A to point B. So price going from one support level to a resistance level in an uptrend. In a downtrend, the price going from a resistance level to a support level, displaying lower lows, lower high, okay? So because the price does not go up or down for no reason, have we talked about this before? Do you know that before? If you don't know, well, it means that you should subscribe to 24 Stock Trader YouTube channel, where I taught traders that no financial instrument, whether currency, commodity, indices, futures, gold, silvers, no financial instrument is going up or down for no reason. It's always headed to a target level. So what is happening is that very often, as the price is going from one point to the target level, if it does not hit the target level, you are likely to see false divergences before the price hit the target level. So as the price is going from point A to point B, the divergences that we see before the price hits point B are usually, I'm using my word carefully, are usually, not always, false divergences. So the question you want to know is, where is the price headed, or which pattern is developing? Is the pattern completed, or is a part of the pattern? For those who understand the Elliot wave, we are talking about multi-wave formed of the first, second, third, fourth, and the fifth wave. So the first wave is in the direction of the trend, the third wave is the direction of the trend, and the fifth wave is also in the direction of the trend. The multi-wave will be completed at the end of the fifth wave, but we are likely to see false divergences during the first and the third wave. I hope I have managed to explain to traders, okay, how to pinpoint false divergences, a trading signal. Remember this: whenever you see any divergence, do not think straight away that it's a false divergence. That would be a mistake. Acknowledge that yes, there is a divergence. The price from a new higher high, stochastic from a lower high. It's a bearish divergence. Yes, the price from a lower low, the stochastic from a higher low. It's a bullish divergence. Acknowledge it. Now, go back to what we have said already to know whether this is a true divergence or a false divergence. With everything said so far, I think you are now equipped or ready to start pinpointing, okay, the false divergence. To close this tutorial, the best approach, as always, you learn something new on YouTube. Do not go straight away live day trading with real money. Use a demo account. Practice, practice, practice. Do you like it? Is it working? Does it make sense? All right. Are you ready? If you are ready, go into the ring with the best professional traders out there. All right. If you are not ready, don't go live with it. Save your money in your trading account. So this will conclude our discussion today about how to pinpoint, okay, false divergence trading signal. If you have any question or suggestion, put in the comment section, and in due course I will be recording another video to answer your specific question. If you find this video truly useful, let us know by giving us the thumbs up. If you think that this is another disgusting blah 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 blah, mark it down, alright? That will put me under pressure to improve my next recording. However, if you think that this is an essential technical trading video about the false divergences, share it with your friend on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about how to pinpoint a false divergence, a trading signal. I invite you now to follow me in the next tutorial when I will be talking more about how to recognize and trade a true divergence, a trading signal like a pro. Happy trading to you all and speak to you soon.